we shifted to a reference portfolio approach. This is the thing that would later become termed the total portfolio approach. It wasn't called that at that point, now it is. But that sort of came alongside us looking to articulate our investment philosophy as a fund. So we were explicit about where we thought our advantages lay. We were explicit about our investment beliefs. And we started talking about, well, where are we going to be most confident in terms of taking active risk, i.e. stepping away from that reference portfolio. And that, funnily enough, started as a project to sort of bridge the language gap between the public and the private markets team. We initially called it a glossary. It turned into our investment framework and became the basis for how we essentially constructed the fund going forward.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Matt Whineray, who recently retired from the role of Chief Executive Officer at the New Zealand Super Fund, 77 billion New Zealand dollars assets under management, where he'd spent close to 16 years in a series of roles, culminating in CEO, which included 4 years as CIO. He previously worked in a series of corporate finance roles and currently holds a number of chair and board roles. Welcome, Matt. Thanks for joining me today.
Thank you, Ethan.
Let's start with a bit about your background and career journey. Can you tell us where you grew up, what you studied, and how you came to enter the world of investing?
Sure. So I grew up in Palmerston North. That's a rural city in the lower half of the North Island of New Zealand. Dad was a lecturer at the local university and Mum was a medical technologist at the hospital. Grew up with 2 sisters and a brother. Sisters went on to become doctors. My brother went on to become an engineer, and I guess the black sheep, went off and studied commerce and law at Auckland University. I became a lawyer for the first few years after university. I worked for one of the large commercial firms in Auckland doing both tax and litigation work. Now, the typical path for lawyers, young lawyers from New Zealand, was to go to London. It was an easy path to follow, but I really wanted to work in New York. And I worked out that the easiest way was to become an investment banker rather than as a lawyer, because at that stage anyway, to be a lawyer in the States, you needed to go and do an LLM or study and certainly pass the bar exam. So I figured out it'd be simpler to become an investment banker. So I managed to switch to investment banking. I got a job at what was then Credit Suisse First Boston in New Zealand. They had a business here. And after a couple of years in Auckland, managed to get myself to New York. I was in New York for a few years working in the leveraged finance team, which was just a fantastic place to be in the late 90s. We did a lot of transactions, leveraged loans, high yield debt, M&A, and IPOs, and I got an awesome amount of experience in all of those. I then came back to New Zealand, and after a number of years in investment banking here, I moved to Hong Kong for a different experience at that stage with a young family. Then just as the credit crunch was kicking off, that we can all be nostalgic about the credit crunch before it turned into the GFC. I got an offer to join the Guardians in a private markets role. So I returned to New Zealand and then spent, as you say, nearly the next 16 years in a variety of roles at the Guardians, culminating in the Chief Investment Officer and later the CEO role.
Amazing. Well, it's amazing how many parallels actually our careers have had. I also started out as a lawyer. I made it to New York as a lawyer. Didn't need to make the shift to investment banking, but the Irish system is a little different, I think, from the New Zealand system. We didn't need an LLM. How did you feel going from the epicenter of global finance, New York, leveraged finance, 90s? I mean, there couldn't be anything more stereotypical, probably. Back to New Zealand. Did you find the New Zealand investment banking climate quite small and in comparison? And did that maybe drive your move to Hong Kong?
Well, it was definitely smaller and generally at a pace that was, while it was fast for New Zealand, was certainly slower than compared to New York. And then sometimes the daftness of it was, some of those transactions you'd work on in New York, probably the fee pot in them was larger than the size of the transaction you work on back in New Zealand. But nevertheless, all transactions are complicated things and are interesting, was certainly interesting for me. But yes, it was certainly a different style and pace. And so for me, the move to Hong Kong was about, going and trying something else. Hong Kong and obviously Asia represented an area that I hadn't spent a lot of time in. And so we moved up there, and the kids were just 1 and 2 at that point. So, yeah, basically toddlers, and was a really, good place to work, certainly for a short period of time, but found that we were quite keen to bring them back to New Zealand, having experienced that, and bring them up here.
Another parallel, I also spent 2 years in Hong Kong, 97 to 99. But again, the question I asked then, given that was still an emerging market, and lawyers would say there's not a lot of precedent for a lot of what you do out there. It's kind of, you have to kind of live by your wits to a degree. There's not always a cookie cutter way to do things. What do you think you brought back from those 2 experiences, first in New York, then Hong Kong, to New Zealand, in terms of your experience of different cultures and different ways of work?
I definitely came back with a massive amount of transaction experience, but also a lot of experience of sort of different people, different styles of working, understood sort of different cultures, I guess, as a result. And I think all of that was helpful for me coming back and able to apply that experience back here. So, yeah, just got a whole bunch of experience that would be very difficult to get down here, and certainly in that sort of compact period of time.
I'm moving now to New Zealand Super, and I know what drove your move there, but I'd love to trace your tenure. So 15 years, long space of time, over 15 years, many shifts, I suppose, in terms of the size of that fund, as well as the economic backdrop. Can you walk us through a little bit of the phases you spent at the fund?
Sure. So the move into it was really the desire. Having done about 13 years in investment banking, I was quite keen to shift to the buy side. And partly that was about living with your decisions longer than the length of a transaction. As the investment banking approach is, you become a sort of an expert in some sector for the length of a transaction, and then you move on and you do the next one. And I was really keen to get into something which had a bit of a longer horizon. And so when the opportunity came up at the Guardians, that seemed like a great way of sort of dealing with a couple of things. One was making that shift from the sell side to the buy side. The other was that one day we were at the Hong Kong Cricket Club, and my daughter, who was about 2 at the time, walked on the grass on the big cricket field, didn't like the feel of the grass on her feet. And for Sandra and I, we just sort of looked at each other and went, that's not on for a Kiwi kid. So the offer from the Guardians enabled us to come back and bring them up here. But when I started at the Guardians, it was a pretty small fund, where it was a small organisation, relatively new fund. So the first money had come in 2003. September 2003 was the first dollars from the government. I arrived in May 2008, so not quite 5 years into it. And there were about 40 people at the organisation. The fund size at that point was about 14 billion, and we were almost entirely outsourced. So for me, coming in, having no experience of investment management, I obviously had a decent background in finance and transaction and lending and structuring. But for me coming in, the private markets role was a really good one, because as it transpired, the GFC kicked off later that year with the demise of Lehman. And because there were sort of fewer moving parts and the private market space didn't move around, it gave me a bit of space to get to grips with how to think about asset allocation, how to think about active management versus passive management. We developed some new investment strategies, including direct investment, and we started looking to do some things ourselves. So, as I said, we were pretty much entirely outsourced when I arrived, and we're starting to think about, well, what things do we need to do? What are critical functions in terms of, for example, managing market exposures, liquidity management, some risk management functions that you just have to get control of yourself, but also finding that sometimes it was very hard to get alignment with managers on particular strategies, and those ones naturally would come in-house as well. So that first phase was really, surviving, I guess, through the GFC as that sort of rumbled through the portfolio, and starting to grow a bit of in terms of sophistication and capability in-house. We set up a direct investment team. We set up a treasury team, which we called portfolio completion. We set up a new strategy, DAA, dynamic asset allocation strategy, and started to do a few things ourselves. It was around that time also that we shifted to a reference portfolio approach. This is the thing that would later become termed the total portfolio approach. It wasn't called that at that point, now it is. But that sort of came alongside us looking to articulate our investment philosophy as a fund. So We were explicit about where we thought our advantages lay. We were explicit about our investment beliefs. And we started talking about, well, where are we going to be most confident in terms of taking active risk, i.e. stepping away from that reference portfolio. And that, funnily enough, started as a project to sort of bridge the language gap between the public and the private markets team. We initially called it a glossary. It turned into our investment framework and became the basis for how we essentially constructed the fund going forward.
Well, that's fascinating. I was going to ask you the genesis of this. You said a reference portfolio became total portfolio approach. Any kind of lessons learned in terms of, as you went to go from outsourcing to set things up, any best practice that you would pass on, say, to the next sovereign wealth fund in another country being set up, governance, discretion versus that being in the hands of a board? Anything that you think absolutely has to be done a certain way?
Yeah, so we created back in those days as well, we just loved frameworks at the Guardian. So in fact, at some point we put a moratorium on frameworks because we just had too many. But we created this thing called a target operating model. And in that we articulated why we would do something ourselves. And that's quite important because it's quite easy to sort of slide into doing things yourselves without being really explicit about what it is that you think you're doing. How do you manage the different risks that come with doing something versus having someone else do it for you? So what we said was, we will do something ourselves where it's a critical risk function that we need to manage. Liquidity management's a classic example of that. We went through the GFC with all of our outsourced managers, and we were trying to figure out where our liquidity levels were, what liquidity we needed, and that was all that we didn't have a picture of that. So creating that team, the portfolio completion team, was really fundamental to that. So that's one reason you bring it in. The other reason we said you ought to bring it in is if you just cannot get alignment. And that often goes to if you're substituting an intermediary, but you're trying to take advantage of an endowment of you as an asset owner, but that intermediary doesn't have that, then that's an issue. So that's a horizon issue often. Often large asset owners will look to save cost or reduce cost by bringing strategies in-house. That was never really a driver for us because I think we always thought, well, implicit in that is that you can replace the capability that you'd be hiring in an external manager internally, and that's not always the case for asset owners. So we had a quite clear view of what stuff we should do ourselves and what others should do for us, and that helped us as we thought about bringing these things in-house. In terms of lessons, I think one of the biggest lessons that we learned in terms of implementing that reference portfolio is when you have a strategic asset allocation approach, there's a lot of comfort in that for investment teams, because if I'm the private equity team, I know I've got 10% of the portfolio. I can do that maths and say, right, I can just go off and do my stuff. Same for the public markets team or the hedge fund team or whatever. When you shift to a reference portfolio and you don't have those types of allocations to non-reference portfolio assets, then you're sort of unanchored. And so when we shifted to the reference portfolio, I know we didn't fully anticipate what that would do in terms of the change for how our team operated. And we sort of scrambled around for a couple of years to build what we called the risk allocation process to provide some guidance to our teams about where they should be looking. Because what you're doing with a reference portfolio process is you're saying, well, we should be able to compare different potential investment strategies across each other. So, if someone comes up with a forestry investment, we want to know, is that better from an active risk perspective than, some hedge fund strategy? And to do that, you need some sort of risk allocation process. And so we took a couple of years to get that. And so there was a bit of unanchored sort of confusion, I think, if you like, for a little while before we got there. That was certainly the biggest lesson we learned from that transition.
Let's paint a picture in terms of the size of the fund and its cash flow profile, for example, its funded status. Yeah. I know it's 77 billion New Zealand dollars is the number I cited at the beginning. I'm not sure what time frame that when it got to that level or whether it's even surpassed that now.
Yeah, so the design of the fund was to create a fund that would smooth out the cost of the universal pension in New Zealand over a 40-year period. So in our legislation, there's a formula in the schedule. That formula is translated into a model that the Treasury owns, and they update that, I think, a couple of times a year. So what that's looking to do is to say, make some assumptions around what the fund is going to earn, what the GDP of the country is going to be, what the number of retirees are going to be drawing national super, and try and have, on a rolling 40-year basis, smooth out the increased cost. So what does that translate to? It means that when we started, we were getting roughly $2 billion a year coming into the fund. And so for the first, 5-6 years of the fund, from 2003 to 2009, that happened. Then we had a change of government, and that government stopped contributions to the fund until 2018. Then we had another change of government, and that one started contributions to the fund again. So we got a bunch of money through to 2009, and then we were just investing that portfolio and the gains that we made on that portfolio, and then we started receiving contributions again. As you go into the 2030s, that's when we'll see a switch from money coming in from the government to money going out to smooth out the increased cost of the universal pension. So right now, the fund is getting some inflows. Those are steadily declining, and then come about 2035, they'll flip around and the fund will start paying out to the government.
Quite a different ball game from, say, the experience I had at Chicago Police, which did have low funding levels, but also had significant outflows at the same time. So at least you said you didn't have those outflows at the time of not getting the contributions.
No, we didn't. We were really fortunate in the setup. The design, it was set up by a finance minister called Sir Michael Cullen, who, his vision was to sort of partially pre-fund the increased cost. And so the design was a clever design, and it gave us a luxury of having a single fund, knowing what our liquidity profile was, which enabled us to have some investment strategies that you wouldn't be able to do. Say, for example, you might have found that in the Chicago fund, where you don't have confidence in your future liquidity profile.
I'd like to cycle through a few topics that come up with a lot of sovereign wealth funds today, and certainly in the case of a fund like yourself, where your total portfolio return approach has now seemed to have gone global. We'll just go through some of the topics, and maybe we can weave in some of the governance aspect and how it related to that. The first one is around local investment. So a lot of wealth funds do have a prerogative or a preference for local investing, and they make a concerted effort to do that. Any challenges and opportunities in investing in an economy the size of New Zealand, and how much of a mandate did you have around that?
Our mandate in the fund didn't have any specific allocation to the domestic economy. The mandate said maximise return without undue risk, do that using best practice portfolio management, and avoid prejudice to New Zealand's reputation. So those were the three legs of the mandate. But we ended up with a bit of a home bias, like many funds like ours do. We didn't have a local sort of development mandate, if you like, unlike some funds. CDPQ is an example of that, or ISIF in the second iteration is an example of that as well. But that said, you've got some advantages domestically in terms of sourcing transactions. But the flip side of that is, it's a small economy, New Zealand. It's 5 million people. It's a tiny part of the global portfolio, and it doesn't have great liquidity. So you've got to be careful that you don't get yourself stuck. So while you can get into some things, that also probably means it might be hard to get out of them. So that said, a few years ago, the government created a new fund called the Elevate Fund, which is a small fund designed to stimulate the venture market in New Zealand and develop additional venture managers. That was set up separately to the super fund. So it's only small. It's only a few $100 million. And we had said to the government, don't mix the mandates here for the super fund. Leave the super fund as it is. If you want to do this, create another one. And they did. And the guardians oversee that. It's run through a government-owned venture fund of funds manager, essentially. But the guardians oversee it. So provide some rigor to the process that way. And that one is purely focused on developing the local venture capital market. So I think that's a good example of trying to avoid creating sort of two masters for these funds. If you've created two targets, you're at real danger of hitting neither of them.
Which brings us to sustainability. And I think the words you use, no prejudice to New Zealand's reputation, I guess that could be subjectively interpreted as well in terms of the impact, say, on climate change or investments in fossil fuel, investments in forestry, clearly a lot of forests in New Zealand. Talk to us about that policy or that approach. How did you build resilience, I suppose, around some of the global challenges all funds face?
Yeah, so the full wording of that clause is avoid prejudice to New Zealand's reputation as a responsible member of the world community. So you're right, that can mean quite different things to you than it might mean to me. But from the outset, when we created our first responsible investment framework, that was the leg of the mandate that hung on, if you like. But what we did with that responsible investment framework, and we were early signatories to the UNPRI, so that helped us develop that thinking as well. But we were quite explicit about what we were trying to do with that framework, and what that was trying to do was that was set up largely in the early days as an exclusionary approach. So what did we not want to invest in? So that was set up in the first instance as an exclusionary framework. Let's define the products that we don't want to invest in, things like tobacco, nukes, controversial weapons, and let's also define the standards by which we'll hold companies to, so global compact, and we'll exclude individual companies that we think breach those standards. So we set out this framework for New Zealanders, and we said, look, we're not here to make everybody happy. What we're trying to do is reduce our exposure to what we think is poor corporate practice and globally. And that was very helpful, being explicit about that. And then, of course, you move into things like, well, how do you incorporate responsible investment considerations into investment due diligence? How do you incorporate them into managed due diligence? We had a responsible investment team that started life in our corporate strategy team, but we moved it into the investment group. And so that responsible investment team reported to me, and we had a head of responsible investment who was a pretty senior person, and Anne-Marie had done a lot of work around the world, very well-respected person in that responsible investment world. And she had, as a result of being incorporated in the investment group, that really became infused all the way through our investment practice. So that was up until about 2018. And then we started a review of that, and we said, let's go and have a look at where practice has got to and think about that second leg of our mandate, which was best practice portfolio management, and also think about this in the context of the first leg, which is maximize return without undue risk. So you think about that undue risk. And what we found in the course of that review was actually all of those legs spoke to the importance of responsible investment now. So it was by then best practice to be incorporating responsible investment in your investment processes, investment decision-making processes. At about that time also, so that was when we shifted from what we called the responsible investment framework to a sustainable investment strategy, sustainable finance strategy. And really what that might sound like a little bit of semantics, but the important difference is responsible investment says, what are all of these issues, and they're often framed as ESG issues? What's the impact of those issues on our portfolio? But what sustainable investment or sustainable finance says is that it considers that, but it also considers what's the impact of our portfolio on these long-term societal or environmental trends, and think about the potential risk that creates to your portfolio over time. Because we're a really long horizon investor, we care about the outcomes for these things over 20, 30, 40, 50 year timeframes. So those things become important, and they can manifest in that time frame. So that shift from responsible investment to sustainable investment was a pretty important move for us about 4 or 5 years ago, and coincided with, slightly after, the development of a climate change investment strategy, which really looked at the same thing. We said, look, we think that climate change isn't particularly well dealt with by financial markets. It's multifaceted. It's uncertain as to when it might manifest. And so we don't think that markets do a particularly good job of pricing that. As a result, we think that's undue risk. So when you think about that leg of the mandate, which says maximize return without undue risk, we said, well, if we're not getting paid for this risk, well, that's undue. So we set about creating a climate change investment strategy that said, how do we reduce our exposure to that risk? And that kicked off the shift to a decarbonised benchmark, the climate reporting, and a much greater focus on both physical and transition risks in the portfolio.
And how about the nature-based side of that? As you know, many institutions in the Europe or UK are looking at net zero targets, and you're getting that net part to zero. It does require nature positive investment strategies. As I mentioned again, New Zealand seems to be thinking of forests automatically thinking New Zealand. Did you have any positive real asset exposure, nature positive, that was a complement of that decarbonisation?
Well, the largest asset in the portfolio is a plantation forest that's a couple of hours south of Auckland. It's a fantastic world-class forest and was a particularly large asset for us from a portfolio perspective. But beside that, I think one of the other areas that we had been pushing into has been more on the mitigation side, so on the development of renewables. So one of our other sort of larger investments in the portfolio is a venture which we undertook with a local New Zealand investment company called Infratil through one of our investment managers, and that's a large US developer of renewable energy generation. So solar and wind, that was a business called Long Road, and that's been investing a significant amount of capital in developing new solar and wind farms in the US. One of the challenges in this space is finding assets of scale or investments of scale. And we're a big fund in New Zealand. We're not a big fund globally. 77 billion Kiwi, call it, 50 something billion US is pretty small by global standards. But even for us, finding investments of scale are challenging. So the next sort of step of that is to go, where do you get a bigger bang for your buck in a sense of the sustainability work? That's probably emerging market renewables, and that's a much more challenging space, and we haven't been able to crack that at this point.
Well, even though you've retired from New Zealand Super, you've not retired from some of these interests around sustainable finance. And in this next chapter, there's a long list in terms of your work you're doing, the Centre for Sustainable Finance, an independent reference group supporting the development of climate change adaptation framework, as well as Netball New Zealand and chair of First Cape. So can you maybe just talk us through some of those in terms of why you've pursued this post-retirement and what excites you about the work you're doing here?
Sure. The sustainable investment side of things was something that I really had a big interest in at the Guardians, and the Guardians was quite progressive, and we did a really good job, I think, of developing and progressing that sustainable finance strategy. So for me, it was a sort of a natural thing to continue on in that space. While I was at the Guardians, I co-chaired an initiative called the Sustainable Finance Forum that produced a roadmap for transitioning New Zealand's financial system to a more sustainable footing, a more diverse, more inclusive, and more sustainable in the long-term financial system. And the idea of that was to, under three broad categories, which we called changing mindsets, transforming finance, and financing the transformation, shift that system by 2030. So I was there at the development of the roadmap. Out of that forum came the Centre for Sustainable Finance, which was the convening body to coordinate the activity. And so as I was leaving the Guardians, I joined the board of that vehicle to continue to help push that initiative along. So that's a domestic focused one, and it's a sort of running in parallel with a lot of other initiatives around the world. There's the Australian Sustainable Finance Institute. The UK has done some great work in this green finance strategy. And we had looked at all of those as we were producing that roadmap and say, there's lots of good ideas out there. What can we use and incorporate into this domestic one? So, keen to continue to see that progress. The adaptation framework one, that just came up this year. So a select committee at Parliament is charged with producing a report on what an adaptation framework looks like for New Zealand. So that speaks to how do you determine where you're going to invest for risk reduction? How do you share costs in terms of this? How do you think about managed retreat or planned relocation in that context? That's a hard one. And what are the roles and responsibilities of central government, local government, banks, insurers in this whole space? That's a pretty crunchy space. There's some quite grunty issues in there, but I'm really enjoying that engagement. So the reference group has people from local government, insurance, finance, Māori sector, and other input as well from the Ministry for the Environment, and is looking to provide some advice to the Minister of Climate Change on how, and that select committee on how you do that. So those are the sort of sustainable finance areas that I've been pretty active in of late. I'm the chair of Netball New Zealand. My wife is a dead keen netball player in her day. She's a coach now. Daughter played netball for a long time. I joined that board about 6 years ago and took over the chair role last year. Netball is the largest sport for kids in secondary schools in New Zealand. That's the biggest sport for women and girls. It's a challenging space, amateur sport, or the intersection between amateur and professional, because we've got an elite professional league, but the vast majority of our participants are playing the community game every day in courts around New Zealand. So I'm certainly enjoying being part of that really broad network.
Fantastic. And I'm very happy for you to have found a framework post New Zealand Super. It seemed like you had didn't get enough of the framework system there. So your adaptation framework there. And it's fascinating on the sports side, I think, just how you can bring experience at the financial sector and the money that goes with that, but, leveraging some of the same forces around in terms of drawing media attention or just attracting funding as well? Because I presume that's a big part of some of the work around the netball in New Zealand.
That is a big part of it. And a lot of that is about trying to rectify the systemic inequity for women's sport in terms of funding. So you have different ways that funding gets into sports. You'll have your own systems over in your part of the world. But what we have seen historically is there's a significant weighting towards male sport in terms of that, and also in the commercialization of it as well. I've got a great T-shirt that I picked up recently which says everyone watches women's sport, and that's absolutely right. People love women's sport, but for some reason women's sport really struggles to commercialize it as much as the male sports do. So that's the big task in that space.
Well, we didn't even get a chance to talk about our diversity in finance story, but I'm sure we don't need to repeat the well-rehearsed adages around lack of representation in the finance world as well. Instead, I'd love to get to some personal reflections, because clearly at an exciting turning point of your career now as you open a new chapter, if you were to look back at the career so far, any highs and lows that really stand out to you?
Yeah. Look, working in New York was great fun. It was a massive learning curve. And, I went through as you said, it was sort of the archetypal sort of hard charging investment banking environment, which was sometimes painful at the time, but you look back in retrospect and say that was a massive amount of experience in a relatively short period of time. The highlight of all of that was working on the IPO of Ducati, the Italian motorbike company, and doing due diligence in Bologna. It had to be one of my favorite transactions of that time. Other highs, look, the 15 years at the Guardians and the transition we went to from 40 people, 14 billion, almost entirely outsourced, to roughly a couple hundred people, nearly 70 billion when I left, as you said, now about 77. And along the way, we built a sophisticated, really high-performing team with a heap of great people, and I learned an awful lot along the way. And one of the things that I really appreciated about that space is amongst the asset owners, there's this great willingness to help people. So early on, I would settle up with Adrian Orr, who was my boss, now the governor of the Reserve Bank, and we would go to places like CPP or ATP or PGGM in the Netherlands or USS, and we'd say, how do you do it? And they'd tell us, and it was fantastic. We weren't in competition. We were a small, highly transparent sovereign wealth fund, so we'd say, well, this is how we do it. How do you do it? And so we made great relationships with the likes of GIC, Ardia, these big funds who we really benefited from the knowledge sharing. And it's not something you're going to find at an investment bank. You can't, if you're at CSFB, you're not going to pop next door to JP Morgan and they'll say, oh, this is how we do it or whatever. But amongst the asset owners, really a quite different feel.
And it probably makes up from the feeling of being a target sometimes as an asset owner when everyone's trying to sell you something and you're everyone's best friend. It's nice to have peers where you actually are just having a conversation. You mentioned some key people there. It seems like some of the mentors you had. Was there anyone in particular who influenced you throughout your career that you want to shout out to now?
Yeah, well, certainly Adrian. I worked alongside Adrian for about 10 years and we had a lot of fun along the way, but we also really learned a lot working at the Guardians and working with others. So absolutely shout out to Adrian. And then a couple of times in my career, I've been handed some responsibility when I might not have thought I was ready for it. And those are quite big moments, I think, in your career. One partner I worked for at the law firm put me in charge of a civil trial. His name was Paul David. He used to look like Oz from Alpha Beta Zone Pet. He put me in charge of a civil trial as a young lawyer. And that was it wasn't a particularly big trial, but it was a really big deal for me. And another who put me in charge of running the transaction when Credit Suisse First Boston fired us all in late 2001, and we created a new entirely staff-owned investment bank in New Zealand. And I was doing the M&A on that. So, that was a guy called Bill Trotter. And so those moments are quite significant for you in terms of sort of step changes in your confidence, I think.
True. And it's important, I think, to remember to pass that on as you're a manager yourself, to remember just how daunting perhaps it can seem, but how important it can be. You mentioned a lot of highs there. You didn't mention any lows or any setbacks or challenges. And I would imagine the path of a sovereign wealth fund, the Guardian, is not exactly a smooth one. There are political challenges, etc.
That's true. The lowest lows were we tragically lost a couple of colleagues while I worked at the Guardians, and they were tragically lost far too young. So that was truly sort of awful times for us to go through and for the team to go through. And that puts everything in perspective when you're sort of thinking about the hammering you get from the media or the select committee or whatever it happens to be. You say, well, actually what really matters, well, we lost Nicola and Tim and that was awful. And that sort of, provides a bit of perspective. But on the fund side, we learned a lot about how to manage our biggest risk. And our biggest risk we figured out was losing the support of our sponsor. I remember very early on at the Guardians, 2009, Adrian sent me off to DC to go to a meeting of what would become the International Forum of Sovereign Wealth Funds. And because it was set up like the UN, New Zealand was sitting next to Norway. And so the guy, Martin Skanke from the Norwegian fund, was sitting there saying, well, we've just gone from 400 billion to 300 billion as a result of the GFC. And he said, and our big risk is that we were in danger of losing the mandate, getting the keys taken off you. And that was a big moment for me. I was like, wow, I would have thought once you're that big, you've got some protection from that. But even at that scale, that is the big risk for a long horizon investor, is that you get stopped out inside your investment horizon because of big ructions in the market. And so having understood that was our big risk, we said, well, we're going to take a lot of risk. The super fund is a very growth-oriented portfolio, 80% equities. So we know that it's going to bounce around. The risk is not that there will be volatility. That's a given. The risk is that our sponsors lose confidence at the wrong time, and it will always be the wrong time because it'll be post a big drawdown, and we'll be stopped out before we can take advantage of the risk that we took. So that lesson, we got slammed by the media during the GFC. Everyone was like, well, the fund's down this much money. And of course, you should have all just been in treasury bonds the whole time. And what were you thinking having any equities? And so we learned a lot from that. Once we got to the big drawdown in COVID, which happened sort of February, March, late February, March into April. I remember I was on the radio and I was talking to this radio interviewer, and I was explaining that we'd gone from 48 billion to 35 billion. And that was a pretty massive drawdown for us. And the response from the interviewer was, well, you'd expect that given how you've set up the portfolio. And that was one of the great moments for me, because that justified all of that work we'd done about, well, this is what you can expect our portfolio to do. This is what's going to happen. That's not the risk. The risk is that we turn it off. And we saw in that one a real fast bounce back, in that the market was already back by, I think it was May, certainly by June, rip back up. So if we'd turned off the risk at that point, we wouldn't have got that bounce. So that was one of the great lessons for us that we'd learned going through these drawdowns, is be really transparent about why you've set the fund up as you have, in our case with 80% equities, because we think over the long term we're going to get paid for that risk. But also be really explicit about what do you think can happen in the short term. So in my first year as CEO, we put a case study in the annual report that said, if we went through a GFC again, this is what it would look like. And because when we went through the first GFC, the fund was smaller, the numbers were smaller. Now we're a lot bigger, so the numbers would be a lot bigger. There'd be headlines and sticker shock. And that was really helpful for us in changing the conversation about why we took risk and what to expect along the way. And it's paid off for the super fund. It's performed really well.
A brilliant strategy, because it really is this kind of pre-mortem almost that we hear about being the ideal way to run a business and also manage expectations. And clearly, if even the journalist knew what was going on, that communication had gone far and wide. My last question is around any creed or motto that you've developed or have lived by or now do live by that you can share, any words of wisdom or maybe advice for your younger self, anything in that category?
Yeah. So again, early on in my time at the Guardians, I was coming back from a conference in Australia, and I was only new to the sort of investment management side of things at that point. And I'd been at this conference, and there was a private market session where everybody stood up and said, our strategy is to invest in the top quartile managers. Like, oh, well, that sounds good. And then the next person would stand up and go, well, our strategy is to invest in the top quartile managers. And our strategy is like, well, who's investing in the bottom quartile managers? Because there definitely is like a quarter of them, right? And then coming home, I picked up this book in the airport called Fooled by Randomness by Nassim Taleb. I don't know if you've ever read that, but you'll certainly know Black Swan. And I read that on the way home, and that was a really useful insight to me into the impact of randomness, the desire of humans to tell stories and to fit patterns to things that don't have patterns, to understand complexity and complex adaptive systems and that kind of stuff. And so that whole idea of understanding the impact of randomness on our lives, on market, was really useful for me as I sort of embarked on that investment management journey. And when you get to the end of that book, the author goes, well, so what do you do with this? And his response is, you go to parties. Because what you want to do is increase the number of random interactions you have with people. You never know which one is going to be significant or important. So you increase the number of random interactions. So I always thought that was a useful bit of advice, and one that, certainly my younger self would be very happy to receive.
Fantastic. Well, I'll certainly love the advice to go to more parties. And as you enter your next chapter, I'm sure you'll have many, many moments of randomness ahead. I'm going to go back to the anecdote you told about your 2-year-old in Hong Kong, because that idea of not wanting to put her feet on the ground is really what led you to put your feet on the ground where you ended up in New Zealand. And what an impact you have made, and how much, not just to the country and to the fund, but also to our way of thinking, I think, as an investment industry. I think New Zealand's impact goes far and wide. You continue to set the standard. And thank you for showing us how it's done and for coming here and sharing your insights with us.
And it's made a massive impact on me. So as I said, one of the great things is being able to learn from so many others. And as Adrian used to say, we look to stand on the shoulders of giants, and we did that all the time as a small fund. So yeah, it's been a great time.
And guardians you were. I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.